Welcome back, everyone, to the second edition of our quarterly uncredited video. Thanks for joining us again. This edition, we'll briefly talk about 2024 expected returns, recent third quarter earnings trends, our sector preferences, and how we're thinking about managing a dollar bond portfolio. I'm Alejandro Estevez-Breton, the Chief Fixed Income Strategist.
Hi, I'm Marcelo Menusso, the Chief Credit Strategist.
Hi, I'm Rafael Gaiao, Credit Strategist, and we represent Itaú Private Bank International.
I'm going to start with two quick points. First, about returns. We expect very good returns for 2024, likely due to three factors: peak Fed rates, good corporate fundamentals, and historically high yields. Second, in 2023, we saw equity performance has clearly reflected a preference for quality, but that has not been reflected yet in credit. We expect this trend to materialize in 2024. Slower inflation and growth are likely to support strong credits like investment grade, while weaker credits like CCC should underperform. Now, going to the earnings trends, first, the share of companies beating earnings expectations were above trend, but in the case of revenues, that was not the case. For instance, 82% of companies had earnings surprises above the 10-year average of 74%, and that's the highest since the third quarter of 2021. In contrast, 62% had revenue surprises that was below the 10-year average of 64, the lowest since the first quarter of 2020. In general, the earnings recession is likely to have ended in the third quarter with a 4.3% expansion. This is the first increase since the third quarter of 2022. However, earnings are still vulnerable to 1 or 2 year lagged effects of higher rates, which could be magnified by further rise in unemployment. Despite a substantial decline in the share of companies citing inflation or recession as risks compared to the second quarter of last year, which was the peak of that concern, we see emerging pressure points in sectors such as housing, auto, credit card, and labor market. This requires monitoring in 2024 to better calibrate the risk of recession. So we're going to shift a little bit here and get into the detail. And we're going to ask Rafael, why do you have basically you like financials and industrials, and you don't like as much communications and non-cyclicals in emerging markets? Is this more of a sector or company view, or is there also a macro component to it?
Our emerging market sector calls are usually based on our coverage, so we always start with a bottom-up approach, but then we combine with the views from our economic team and also other strategists as ourselves, Alejandro, that has a more macro focus to get the full picture. We balance both styles with a relative value analysis of the sectors to define our calls that are published weekly in our new report, Market Monitor. For instance, we are underweight in consumer non-cyclicals, mainly because we expect slower economic growth that should impact the sector, but the bonds in the sector are trading in line with other peers. We don't like the communication sector, but in this case, it is specific of the companies in our coverage, not related to any macro thesis. We like financials. The banks in our coverage are solid, and they are trading at a good premium to peers. And we are overweight industrials, based on our company's strong cash generation, but also because of the nearshore investments that are helping Mexican companies.
Great caller. Thank you, Rafael. So now starting to look at more the high level, Marcelo, how do you think about managing a portfolio in dollars, both in emerging markets and in US dollars? And do you have a preference in terms of sovereign or corporate into 2024?
Yeah, that's a great question, Alejandro. The volatility in the bond market has been really remarkable. In the past few months, the swing in yields has been very, very pronounced. So, for example, in October, we had a sell-off in the long part of the treasury curve. So the 10-year US treasury touched 5%. So that's a very strong reminder to investors that's very important to control for duration in their portfolios. Then in November, precisely the opposite has been happening, and we are experiencing a very strong rally in bonds. The same 10-year US treasury is now close to 4.3, 4.4%. Now, that's another reminder, is a reminder that market conditions, they change very quickly, and over time they might become very different. The high yield levels that we're experiencing right now might actually be very hard to find in the future. The bottom line is that we like credit quality. So we still think that US investment grade is a great place to be. And it's important, again, to manage duration. So when considering US investment grade, we think that's best to go to maturities up to 10 years. We think that the sweet spot in terms of duration for a credit portfolio right now is anywhere between 4 to 5 years. Regarding your question on emerging markets, we still also like quality. So we also like investment grade in emerging markets, and that's for both sovereign and corporate bonds. Now, if you were to compare both asset classes and to make a choice, we would go with corporates, and that's precisely because of duration. The duration is shorter, and that's something that we like for emerging market corporate bonds. And on top of that, they're paying a nice premium over the sovereigns. Finally, we also see opportunities in high yield, but again, credit quality is paramount. So even in high yield, we think it's best to stick with quality. So in other words, we're saying the double B credits, which are only one notch below investment grade. We definitely think that the investor should avoid the lower credit quality credits, such as Bs and single Cs. But if the investor wants to invest in these asset classes, then it's important, very important actually, to manage the size of the exposure and to also be very careful about the credit due diligence.
Thank you very much, Marcelo, for your insights, and Rafael. Thank you, everyone, for joining us today. If you have any questions, please feel free to reach out to your banker or your investor, and see you next quarter with a new edition of On Credit.